Ready to start recording now. And welcome to the 24th Annual Capital Conference, virtual edition. It is our goal that each session is about an hour in length. However, we may go a little longer or we may be shorter. My name is David Stevens. I'm the Director of Academic Activities for UIL. Also assisting with this session is Glenda Munoz, Administrative Assistant for UIL Academic. Thank you, Glenda, for helping us. This session is Accounting, Accruals, and Deferrals. Our presenter is LaVerne Funderburk. LaVerne has been our contest director for accounting since the inception of this contest in 1983 or so, and I think the state meet was 85, or it's been 30-something years. I don't know. LaVerne, you can clarify that if you want, but thank you very much for what you do and being willing to share this wisdom and knowledge with our attendees in this new format of Capital Conference.
Okay, thank you, Dr. Stevens, and thank you, Glenda, for being our host today. And to clarify, I think this is year 37, but my math's not always so good without a calculator. To all the attendees, let me say welcome and hello. And I wish we could be in person, but I think we all have that wish about a lot of things. So we will do the best we can under this venue. As your state director, I hope you feel comfortable to email me anytime throughout the school year if you have contest procedure questions or if you just need help working prior your test questions. My email address will be on a slide at the end of this presentation. And there will be a few opportunities throughout the presentation where I'll pause after each main topic area to see if any of you have any questions. So please use the chat for your questions when they are appropriate to the topic. So let's begin this joyful coverage of accruals and deferrals. First, we're going to review basis of accounting, revenue recognition, matching principle, and accounting period cycle. With the cash basis of accounting, we record revenue when we get the cash, and we record an expense when we pay the cash out. The cash basis is not acceptable by generally accepted accounting principles. We call that GAAP. And that's because the cash basis does not follow the matching principle. With the accrual basis of accounting, and this is my favorite, we record revenue when it's earned, regardless of when the cash happens, and we record expenses when they're incurred, regardless of when the cash is paid out. And the major benefit of the accrual basis of accounting is that information in the financial statements are comparable from period to period. Revenue recognition, that's the GAAP principle that says you record the revenue on the date it's earned, even if you don't have the cash yet. And the matching principle says when you do record that revenue in the period in which it's earned, you record the expenses that helped you earn that same revenue in the same accounting period. The accounting period cycle. Now, this means that financial statements are prepared for a specific period of time. Some textbooks refer to this as the time period concept. An accounting period for financial statement purposes, and I'm not talking about when do we close the temporary capital accounts, but for financial statement purposes, that period can be any length you want. It could be 1 month or 3 or 6 months, but typically you always have a financial statement at least once at the end of that, we call it a fiscal year. So any accounting period of 12 consecutive months is called a fiscal year. And I'll just tell you, one of my pet peeves is when someone pronounces this word fiscal as physical. Now, in accounting, we do refer to some physical things like taking a physical inventory, but it's not the same thing as that 12-month period of time. So a fiscal period could be from July 1 of 2020 through June 30 of 2021. When a fiscal year ends on December 31, it's not only the calendar year end, it's also your fiscal year end. Before financial statements are prepared, we as accountants must make sure all accounts are up to date. So the accountant will typically need to make adjusting journal entries. Again, a little bit of review, and I certainly do not mean to insult anyone's intelligence, but it's important that we review a few very, very basic things, because in that review, we are solidifying the entire double entry accounting system. It's imperative that we understand this in order to ever think we can understand accruals and deferrals. So here's the accounting equation. Assets equal liabilities plus capital. So notice that the accounting equation is the same thing as a balance sheet. Balance sheet accounts are permanent accounts. Now, another name for the capital account is owner's equity. And there are 4 things that affect the capital account. First, to increase capital, it might be by an owner investment. These are the increases, or it could be from revenue. The way we decrease capital is if the owner takes a withdrawal or if there are business expenses. Now, for our purposes today, let's assume, excuse me, that we are working with a sole proprietorship and a service business. Again, some relationships between the balance sheet and the income statement, and we're just going to look at these very quickly. Assets equal liabilities plus owner's equity or capital. So here are your permanent accounts. Now, I like to teach students that this equal sign is the most important part of this equation, in that it dictates where the balance sides are in our various accounts. So if an account is to the left of the equal sign, that balance side is going to be on the left. If the account is on the right-hand side of that equal sign, the balance side is going to be on the right. And of course, we know that if it's a balance side, it's the sign that is the increase side, and then the other side is the decrease side. Please teach your students that debits are not good or bad. Neither are credits. Simply, debit means left, credit means right. Now, when an owner makes an investment in the business, this is recorded directly to the capital account. However, we anticipate in our business we would have revenue accounts and many different expense accounts or transactions, and we don't want to clutter those in the capital account. So we devise various temporary capital accounts like sales or fees earned, and a lot of different expense accounts. So here comes our temporary revenue account. And notice that because revenue increases capital, and where do we record an increase to capital? On the right-hand side. That's why revenue has a balance on the credit side. And here comes our expense account, same theory. an expense would have been recorded directly to the capital account as a debit. Therefore, an expense has a balance side on the debit side. Now, we also have a temporary capital account for the owner's withdrawals, but I didn't put it on this slide because it's not a part of our discussion today. Now let's talk about adjusting journal entries. And I have a habit of calling those AJES. So if I slip that in, just know that that's what I'm talking about. With an adjusting journal entry, there is no document coming into your inbox or email that tells you what the AJES are. The accountant becomes a detective. Okay, I'm sorry. So before financial statements are prepared, the accountant must examine the general ledger accounts to make sure they are up to date. The accountant may need to examine insurance policies or take a, here it is, physical inventory of supplies. The accounting worksheet is a great tool because the worksheet has a place for you to record the trial balance to make sure your general ledger is in balance before you get started. And then it gives you a place to plot and plan the adjusting journal entries. So there are two kinds of accruals. One is on the revenue side and the other is on the expense side. And there are two kinds of deferrals. Again, one is on the revenue side and one is on the expense side. Creating adjusting journal entries never affects the cash account. Now, that doesn't mean that on your worksheet you couldn't, say, have a correcting entry of some kind. I think on one of the test problems, sometimes I'll have you, the accountant has failed to record the service charge, hadn't done the bank reconciliation. And so, you know, I'm going to tell you, I know this is an adjusting entry, but here's where you need to put that. But typically, when you're the accountant and you're figuring out what the adjusting journal entries are, they should not affect cash. An adjusting entry will always affect a balance sheet account and an income statement account. Again, that's one reason why I went over those T accounts for the permanent accounts and the temporary capital accounts, because throughout this presentation, we're going to talk about relationship between accounts and relationship between the balance sheet and the income statement. With accrual basis financial statements, we're going to focus on events and not on cash. We would ask ourselves the question, did we earn revenue in this fiscal period that has not yet been received? And did we incur expense in this fiscal period that needs to match to the revenue of this period, even though we haven't paid for it yet? So timing is everything. If we could squash together all the reporting periods and just do a financial statement at the end of the life of the business, we wouldn't have this problem. But we don't want to wait that long to find out how the business is doing. So timing is why we have to think of accrual entries and deferral entries. Throughout this presentation, I'm going to use this format where you see past and then now and future. Again, we're talking about time, so this is appropriate. And anytime you see now, imagine that it's the end of the fiscal period. We've got the worksheet in front of us and we need to do adjusting journal entries before we can prepare those financial statements. And with accruals and deferrals, sometimes things happen in the past that dictate an entry to be made, or sometimes we have to create an entry now that's going to have a future action to close that out. So we might need to accrue revenue because we've earned it, but the customer has not yet paid us. Or we might need to accrue expense even though we haven't paid it yet. And at some point in the future, there will be cash action. And I'm going to use that term a lot. I don't think it's in your textbooks, but I use it. It helps me to understand, am I dealing with an accrual or am I dealing with a deferral? When does the cash action happen? So we're going to begin with something that you already know. You may just not know the names of what you already know. So let's talk about accrued revenue. So focus on the now column. And again, visualize, you've got the worksheet in front of you, and we need to plot an adjusting entry for accrued revenue. Now, the definition of accrued revenue is we've earned the revenue, but we haven't received it in cash, nor have we recorded it yet. We would debit accounts receivable and credit a revenue account. And this is one of the earliest transactions covered in the high school textbooks. In this case, fees earned is accrued revenue. And at some point in the future, your customer should pay you what they owe you. So the theory is, with an accrued revenue, there will be cash action in the future. Now recall my statement that every adjusting journal entry will affect at least one balance sheet account and at least one income statement account. So with each AJE, there is a buddy or a partner relationship between the two financial statements. Here's our adjusting entry we just talked about, accrued revenue. So fees earned is our accrued revenue. And accrued revenue will be reported on the income statement. Here's the T account for revenue. What is accrued revenue's buddy? What is accrued revenue's partner on the balance sheet? Well, what kind of account is accounts receivable? It's an asset. So accrued revenue's buddy is an asset. And here it is more properly stated. With an accrued revenue, the account relationship between the two financial statements is asset and revenue. Now let's focus on that buddy account. Let's analyze how it is created and how it is disposed of in the future. So here's our accrual for revenue. The buddy account for an accrued revenue is an asset, in this case, accounts receivable. When we record an accrued revenue, we create or increase an asset. Now here is the future cash action entry. Notice that this cash action either disposes of or decreases the buddy asset. Sometimes it takes more than one accounting period to totally dispose of the buddy. I want to emphasize that account relationship. When you accrue revenue, you increase the buddy asset or accounts receivable. In the future, when the cash is received, the buddy asset is decreased, or in some cases goes away completely. Now we're back to that issue of time. Well, first of all, if that customer had just paid us when we did the work, we wouldn't have to accrue the revenue. If the red arrow could remove accounts receivable completely in both the now column and in the future column, what would be left between the two spaces of time? We would have a debit to cash and a credit to revenue. The problem is the earning and the receiving happened in two different time periods, and we cannot press two time periods together into one. But the beauty of the accrual is that it allows us to record events regardless of cash. So this is the coverage for an accrued revenue. Do we have any questions at this point?
The box is clear so far.
Okay, here we go. Accrued expense. Well, guess what? You already know this one too. Perhaps you just didn't know what to call it. Once again, focus on the now column. You've got the worksheet in front of you. You're plotting and adjusting entry for an accrued expense. Let's say that in order to earn the revenue we just accrued, we also incurred gasoline expense, but we haven't paid for it yet. The definition of an accrued expense is expenses incurred but not yet paid by cash, nor are they recorded. In other words, we haven't made a journal entry yet. So we're going to debit an expense and credit a liability. In this case, gasoline expense is an accrued expense. At some point in the future, you have to pay what you owe. So at some point in the future, cash action will take place. Once again, there is a relationship between the income statement and the balance sheet. So here's our accrued expense entry. That accrued expense is going to be reported on the income statement. So here's the T account for expense. What type of account is the partner to accrued expense? What's its buddy on the balance sheet? What kind of account is accounts payable? It is a liability. So accrued expenses partner on the balance sheet is a liability account. And here it is more properly stated. With an accrued expense, the account relationship between the two financial statements is liability and expense. Now we're going to focus on that buddy account. Let's analyze how it's created and how it's disposed of in the future. So here's our accrual for the expense. The buddy account for an accrued expense is the liability called accounts payable. When we record an accrued expense, we create or increase a liability. Now here's the future cash action entry. Notice that this cash action disposes of or decreases the buddy liability. Again, I want to emphasize that buddy relationship. When you accrue the expense, you increase the buddy liability, or in this case, accounts payable. In the future, when the cash is paid, that buddy liability is decreased, or in some cases goes away completely. And here we are, again, back to that issue of time. if we had just paid our supplier when we incurred the expense, we wouldn't have to accrue the expense. If the red arrow removed accounts payable completely in both the now column and in the future column, what would be left between the two spaces of time? We would have a debit to expense and a credit to cash. The problem is the incurring and the paying happened in two different time periods. So let's review both kinds of accruals and see them on the same page. Remember, the now column is our worksheet where we plan our adjusting entries. So here's that accrued revenue entry. Fees earned is the accrued revenue, and it's reported on the income statement. An asset account will always be accrued revenue's buddy or partner on the balance sheet. And at some point in the future, the customer will pay us. Well, we hope they will. Notice that with an accrual, the cash action takes place after the period in which the accrual was first made. Here's our entry to accrue expense. Gasoline expense is the accrued expense, and it's reported on the income statement. A liability account will always be accrued expenses buddy or partner on the balance sheet. And at some point in the future, our business must pay what it owes. Notice that the cash action takes place after the period in which the accrual was first made. Are we clear about accrued expense before we move on?
It is looking like there's no questions yet. If you have questions, don't hesitate to put them in the chat box.
We're just going to look at a sample group from a state test. We're to match each situation with the best term using this code. And I went through, since we haven't covered deferrals yet, all of these that we're going to cover will either be an accrued revenue or an accrued expense. And we'll come back to this problem after we have looked at deferrals. So the first question is, our business owes property taxes that have been assessed, but we haven't paid it and we haven't recorded. This indicates that I need to accrue an expense, so the answer is B. Rent not yet collected, already earned, but not yet recorded. So I need to accrue this revenue, so the answer is A. An expense is incurred, not yet paid or recorded. That one to me just kind of jumps out as, well, that's easy. That should be B, an accrued expense. Usually when you see in the test question where it says earned, well, that means revenue. Or if it says incurred, well, that means I have an expense. I need to record an expense. Here it is, a revenue earned, not yet recorded or collected, so the answer is A. Of course, these may have seemed easier because deferrals weren't mixed up in there too, but we'll come back to this problem after we go over deferrals. So here we go. Timing is everything. Now we're going to talk about deferrals. And these are really quite fun because who doesn't like to procrastinate? The definition of defer, as we use it in accounting, is to postpone or put off. With a deferral, oh, this is so important that you see this. With a deferral, the cash action takes place first. We defer an expense when we have paid cash for it, but we have not yet used or consumed it to help us earn revenue. This is a prepaid expense. We defer a revenue when we have received the cash for it, but we have not yet earned it. So this is an unearned revenue. A deferral is created with cash action happening first. So here we are, this is the reporting period that we're in, where we're trying to figure out our adjusting entries, but that deferral happened sometime in the past. The deferral was created when we received the cash. So in the current reporting period, we analyze the prior period deferral and make any adjustments needed. Remember this important clue: with a deferral, cash action happens first. The creation of a deferral, in other words, when you get the cash, the creation of a deferral is not an adjusting entry. Remember that an adjusting entry never affects cash. So that adjustment of the deferral would happen in the in the current period that we're working on. We're going to start with one you probably already understand as a prepaid, and that is supplies. With our high school textbooks, it is customary to record the purchase of supplies in an asset account. Supplies is an asset, but it is also a prepaid expense. Another name for this is a deferred expense. At some point in the past, we bought supplies, and to keep it simple, let's just say we paid cash at the time we bought the supplies. We didn't put it on a credit card first or whatever. So the cash action creates the deferral. In our current reporting period, we have that worksheet in front of us, and we become a detective and we analyze the supplies account. We take a physical inventory of the supplies. We want the asset account called supplies to end up with a balance that agrees to the physical inventory we just took. So here is our adjusting entry. We are expensing the supplies that are no longer in the supply cabinet or closet or room. We are adjusting the prior period deferral. So what we are expensing is considered expired cost. And therefore, whatever is remaining in the supplies account, the balance on the balance sheet, is an unexpired cost. Now, we just examined supplies as a deferred expense. The deferred expense becomes an incurred expense with consumption of the supplies. When we purchase insurance, we cannot debit an expense account when we write the check for the insurance premium. Cash action creates the deferral. and prepaid insurance is a deferred expense. Now, sometimes a deferral is adjusted because of the passage of time, as is the case for insurance. An insurance policy typically covers 1 year. So if you renew, say in the month of November, let's say November the 1st, well, you have 2 months on your 12-month financial statement that you have actually incurred 2 months of insurance expense. But the rest of that is an unexpired cost and would need to stay on your balance sheet. In the current reporting period, the accountant becomes a detective and needs to analyze all of the insurance policies to determine 2 things: the dollar amount of the premiums that have expired, so that these can be reported on the income statement as expense. And we also need to determine how much to reduce the asset account so that prepaid insurance ending balance agrees with the policies still in force. In other words, what sits on the balance sheet in prepaid insurance needs to be the unexpired cost. Let's think about assets in a new way. Why does a business want the cash account to grow? Well, there's a lot of reasons, but here's just a few. We need that cash in current operations. We need to buy things that help us earn revenue. We may need to expand our operations. We may need that cash to open up another store or whatever. Maybe the owner would like to have cash for personal use. Why is accounts receivable on the balance sheet? Well, the business is waiting for it to turn into cash. We hope it will turn into cash and not an uncollectible account. Why do we need deferred expense? To be able to use that in the future to help the business earn revenue. And one final question. Why are deferred expenses on the balance sheet? And here's the golden ticket. They are sitting on the balance sheet, waiting to grow up to be an expense. There is that account relationship between the balance sheet and the income statement. I'm going to keep pounding on that relationship between the balance sheet accounts and the income statement accounts. Let's think about a deferred expense like prepaid insurance. So prepaid insurance is an asset. It's sitting on the balance sheet, waiting to grow up to be an expense. The asset should represent unexpired cost. So now we're looking at our current period worksheet. We analyze the insurance policies and we need to make this entry. Notice that we are decreasing the asset called prepaid insurance. If we did not make this entry, the asset account would be overstated. So the expired cost goes to an expense account. If we did not make this adjusting journal entry, expense would be understated, and therefore net income would be overstated. Now, the remaining unexpired cost, and I said unexpired, still sits on the balance sheet waiting for a future period when it will be incurred. as an expense. Do you recognize the beauty of the double entry accounting system? Assets and expenses both have a normal debit side. That is why, in essence, we are moving $100 from an asset account to an expense account. And we are doing that with this adjusting entry. Any questions so far about deferred expense? We still need to cover deferred revenue.
I have one question. Donnell asks, so do you do this each month?
You do adjusting entries anytime you want to prepare financial statements. So if your business only wants a financial statement at the end of every year, you only need to do this before that year end or at the year end when you're about to prepare financial statements.
That's all we have so far.
Excuse me. All right. We're going to move on to deferred revenue. Again, timing is everything. A deferral is created with cash action that happened before our current reporting period. So it happened somewhere in the past. The account unearned revenue is a liability that will be satisfied by delivering the product or service that was paid for in advance. Excuse me. Remember this important clue. With a deferral, cash action happens first. The creation of a deferral is not the adjusting entry because the adjusting entry never affects cash. In the current reporting period, we analyze the prior period deferral. So the deferral was created in the past, but here with our worksheet, we may need to adjust that deferral. Okay, let's say you are an event planner and your fiscal year end is December 31. You are hired on December 28 of 2019. That's 2019. And you require a payment in advance of $1,000. This event will take place in January of 2020. The cash action is recorded on the day you received the cash in 2019. So always do the easy one. How was cash affected? We know we need to debit cash. But at this point, you have not yet earned the revenue. So we cannot credit a revenue account. I have a question for you. What happens? I've received this $1,000. I'm going to plan this event. What happens if I don't do this job at all? Do I get to keep the money? Probably not. So until I perform, I owe the client the money he paid in advance. Kind of sounds like a liability, right? So unearned revenue is a deferred revenue. It is a liability, and it's a current liability. It's going to be shown that way on the balance sheet. The cash action created the deferred revenue. We are postponing the revenue recognition until we have earned the revenue. So now fast forward to the worksheet. We're about to prepare financial statements for the end of January 2020. Again, there's no email, there's nothing in our inbox that tells us we need to make this entry. We have to look at the accounts and realize, oh yeah, I recorded that money in December, but I have it sitting here on the balance sheet in unearned revenue. We need to determine, have I earned it? And so, yes, I earned it in January. So I need to record that revenue. I need to credit fees earned. I'm not going to debit cash because I already recorded that back in December. So I'm going to debit unearned revenue. A deferred revenue sits on the balance sheet as a liability waiting to grow up to be a revenue. I'm going to keep pounding on the relationship between the balance sheet accounts and the income statement accounts. So let's focus now on a deferred revenue. Unearned revenue is a liability sitting on the balance sheet, waiting to grow up to be earned revenue. If we don't perform in the future, we owe it to the client or customer, like we would have to pay it back. So now we are looking at our current period worksheet. We analyze the account and need to make this entry. Notice that we are decreasing the liability unearned revenue. If we did not do this, the liability account would be overstated. Liabilities would be overstated if we didn't make this entry. So the earned revenue goes to a revenue account. What if we didn't make this adjusting entry? Then revenue would be understated in January and net income would be understated. Here again is the beauty of that double entry accounting system. Liabilities and revenues both have a normal credit side. That is why we are in essence moving $1,000 from a liability account to a revenue account. Now we're just going to review accruals and deferrals, but I want you to pay close attention to the title of this slide. We are not talking about cash action after an accrual. We're not talking about cash action that creates a deferral. We are analyzing the relationships as they would appear in the adjusting entry columns of a worksheet. So with accrued revenue, again, focus, we're talking about the worksheet adjustment columns. If you accrue revenue, who are the buddies? That would be revenue and an asset. If you accrue an expense, who are your buddies? The expenses buddy would be a liability. With a deferred revenue, remember, we're not creating the deferral here because that takes cash and adjusting entry can't have cash. What we're doing is we are adjusting the prior period deferral because now we have earned it. So we record the revenue and we reduce the liability. And finally, a deferred expense, we are adjusting the prior period deferral because now we have incurred it. In the previous slide, we examined the account relationships for the adjusting entries for accruals and deferrals. this slide shows what happens when we fail to make necessary adjusting entries for accruals and deferrals. So if we fail to accrue revenue, what is wrong with our financial statements? Well, if we don't accrue, the easiest one to understand is if we don't accrue the revenue that we've earned, then revenue is understated. And it follows suit then on the income statement that net income will be understated as well. Well, without that accrual, there's no buddy here. So assets would also be understated. With an accrued expense, if we do not record it, our expenses are understated, our liabilities are also understated. Now, look only at these two lines for the accruals. Notice if these entries are not made, everything in all those relationships are understated. Now let's look at deferrals. If, again, in the past, cash action created the deferral. Now in this, we are looking at adjusting those deferrals. If we don't make the adjustment for earned revenue, then revenue would be understated, and that unearned liability is still sitting on the balance sheet, so our liabilities would be overstated. Think about supplies or prepaid expense. If we don't make that adjustment, our assets are overstated and our expense is understated. Just look at those last two lines for deferrals. If we fail to make any of these adjusting entries, I wonder if I have my slide wrong. Hang on. Oh yeah, that's right. Our revenues and expenses will be understated, but our liabilities and assets will be overstated. I was hoping it would kind of follow suit, like all of these are understated, and then maybe all of these would be overstated, but it does not work that way. I do not recommend that students try to memorize this chart. A lot of times on the especially the state test, there might be questions about failure to record or make adjusting entries for accruals and deferrals. And rather than try to memorize this theory, I just get my scratch paper out and I say, okay, if I fail to accrue revenue, well, what would that entry look like in the first place? I would be debiting a receivable and I'd be crediting revenue. Okay, now I'm going to look at that entry and say, well, what if I don't do that? Oh, well, my assets are understated and my revenue is understated. That's what I would recommend. I do find joy in the way double entry accounting works. It's just the most beautiful puzzle. Now, we need to talk about what we name accounts. A lot of times coaches, teachers will email me with those kind of questions. Naming the accounts is really up to the individual accountant or perhaps the company policy. It may depend on if reversing entries are used or not used. But let's look at an accrued expense, and this is a firsthand, I can explain this one from firsthand dealing with my clients, why I use a certain title or why I use a certain type of account. When you have to accrue salaries that the employees have worked, let's say it's the last few days of the fiscal year, let's say it's December 31 fiscal year end, and they worked several days at the end of December, but the normal pay period, like let's say I pay every Friday, that doesn't happen.
Sorry, I missed that. Could you say it again, please?
Oh, how funny. I must have said something that she thought I was talking to her. So the employees have worked, they have earned their wages, but they don't get their paycheck until a day that's dated in January. Well, I need to accrue salary expense for those days that they worked in December so that that salary expense is on my December or that fiscal year ends financial statement. If I could debit that to salary expense and then credit salaries payable. I could do that. But with the clients that I deal with, I not only do their accounting, but I prepare their payroll reports quarterly and their annual payroll reports like W-2s. I also do their corporate tax return or their individual tax return. So I'm always on the lookout for how do I do things in such a way so that if my client were ever audited by the Internal Revenue Service, that certain things would just be clicked right off that, yep, you did this right. Yes, I find that. One of the things that they look at is when you prepare those W-2s, there will be a transmittal page called a W-3, and that W-3 will show the total amount of salary or wage expense for that calendar year. I want that amount to agree exactly to my salary expense account in the general ledger. So if I book an accrual and I use salary expense, I just messed up that relationship. It will take a reconciliation and say, okay, well, here's why it doesn't agree. So I personally would use a separate account called accrued salary expense. And then you could use accrued salary payable or just salary payable. One thing about putting the word accrued and setting up a separate account is that if your company does use reversing entries, it's real easy to find the adjusting entries because they all have the word accrued in front of them if it is an accrued expense or accrued revenue. And so for accrued revenue, an example of that might be accrued interest receivable on a note, or you could just use interest receivable. And then accrued interest payable, or you could just use interest payable. There's really no, you have to do it one way or another kind of rule. And very briefly, we are not going to go into great detail. I'm certainly not going to show you any test questions or anything about reversing entries, but it is important to cover reversing entries. They are optional. A reversing entry is the exact opposite of a specific adjusting entry. One of our high school texts suggests to record a reversing entry whenever an adjusting entry creates a balance in an asset or a liability account that initially had a zero balance. In other words, when you make your entries, your adjusting entries, your accruals, make that buddy account be one that starts out with a zero balance. Reversing entries are made on the first day of the new accounting period. Reversing entries do simplify the recording in the new period. And reversing entries for our textbooks are not used on deferrals. I want to just briefly say that The time that you might want to use reversing entries is if you're the accountant and you have a large accounting department where you have other people, clerks or whatever their positions might be called, where one person, all they do is payroll. Another person, all they do is deal with customers and accounts receivable. Then you have accounts payable people, and they know their specific parts of the system inside and out. They know what to debit and they know what to credit, but they do not handle the general ledger. So sometimes the accountant may not want to mess with what those people are used to doing. Just let them do the normal, ordinary, this is how I do my job. So that the accountant might make these general ledger entries, these adjusting journal entries, and then end up reversing them just so those different clerks don't have to know what I did. They just keep doing their normal work. And then the other thing I want to touch on, reversing entries are not used on deferrals. There is an alternative method of recording prepaid expenses that you don't put them to an asset account. You instead just stick them in expense accounts. And then the accountant would make an adjusting entry at the end of the period to move those unexpired prepaids from the expense account to the asset account. In other words, it's just reversed of what we're typically used to doing. It may seem kind of foreign, but let's say you've got the accounts payable person who they know their job, and they know that every bill that they enter is going to go to some expense and it's going to credit accounts payable. Well, they don't know if supplies have been used or not used, so they just expense them. It's the accountant's responsibility then at the end of that reporting period. Somebody's got to take a physical inventory of those supplies, and then the accountant makes the adjusting entry to drag it back out of expense and stick it on the balance sheet just long enough to prepare the financial statements and get to the end of that fiscal period where the temporary capital accounts are closed, and then that accountant may do a reversing entry so nobody has to know what happened at the general ledger level. And then the same thing holds true with revenues. The clerk that deals with customers, when he or she gets this check, they're going to deposit debit cash. They're just going to credit revenue. They don't necessarily know whether we have or haven't earned it. So again, that accountant would have to move, if it's unearned, would have to move it out of revenue and put it into unearned revenue. Do we have any questions about deferred revenues or anything we've talked about so far?
We do. Chris asks that clearing deferred revenue could be made over several months as it is earned, right?
Okay, that is correct. The question is, let's have the cash action. So I get a check and I'm performing services, and I get that check in December. So I'm going to debit cash, I'm going to credit unearned. But let's say I prepare monthly financial statements and I'm doing an audit for a client, which thank goodness I don't do audits. It's like I don't do windows, I don't do audits. But let's say I did, and let's say that audit takes me January and February to complete. So at the end of January, before I do those financial statements, I'd need to take it out of unearned and put it into revenue according to, again, what does the IRS allow? Am I cash basis? Am I not? I don't want to get bogged down there. But I would record some amount as being earned in January, and then in February, if that's when I completed the project, the rest of the revenue would be recorded then.
And the question, can we get a copy of this presentation?
Yes.
And we'll post it on that Capital Conference online page, which the link is above in your chat box there. So once we get that finalized and get it from LaVerne, we'll get it posted along with the recording of this session. So, any other questions we might have? Looks like you've done a great job. We really appreciate you sharing your information with us, LaVerne, and thanks to all of you for joining us today.
Dr. Stevens, do I have a little bit more time?
Sure.
Okay. Well, we're going to have a test now, so everybody has to get out. Everybody has to get out a sheet of paper, and I'm just kidding. We're going to kind of go through these pretty quickly. This is that same question that we started, but now I've added the deferrals to it. So number 20, an expense not yet incurred, but paid in advance. This is creating the deferral. So that is a deferred expense. I owe property taxes. This is one we've already covered. The answer is B. A revenue not yet earned, collected in advance. So this is the creation of a deferred revenue. So the answer is D. Office supplies on hand and paid for will be used next accounting period. I am creating a deferred expense. So the answer is C. Rent not yet collected, already earned but not yet recorded. That would be an accrued revenue. An expense is incurred, not yet paid or recorded. So that would be an accrued expense. A revenue is earned, not yet recorded or collected. That's going to be an accrued revenue. One more type of theory. I'm just going to show you a few of these. You can look at these on your own, but even these theory-based questions can rise to different levels of intensity. And so this one kind of steps it up a notch in that you not only have to decide, is this an accrual? If so, is it accrued revenue or accrued expense? Am I creating the accrual, or is this the future cash action, or is this a deferral? If it is a deferral, am I deferring expense or revenue? And if I'm creating the deferral with cash action, or am I adjusting the prior period deferral? So there's lots of choices and combinations. And to top it off, you're not just identifying, you must decide what kind of account is debited or credited. So when a deferred expense is purchased, now rather than just put the ABCD, I am putting the name of the account type. I think that may make better sense for our purposes here. So I'm not purposely not reading the instructions. I'm using some leeway here. So when a deferred expense is purchased, I know you teach your students when you can't figure out a transaction and it has cash in it, try to do that first. So if we've bought something, we know we have to credit cash. We cannot debit an expense on the income statement because we haven't incurred it yet. So that would be like supplies. When a revenue has been earned but not yet received, earned popped out at me, so I know I need to credit a revenue, and if I haven't received cash yet, that's some kind of receivable. When an expense has been incurred but not yet paid, incurred tells me, ding, 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 I have a current expense, but I haven't written a check yet. So there's a liability. When a previously deferred expense has now been used. So this is not the creation of the deferral, this is the adjustment of the deferral. So I've incurred some kind of expense now, and I need to credit or reduce that buddy account. When a previously unearned revenue has now been earned. Earned, ding, 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 fees earned. So the buddy account was that liability, unearned revenue. When an unearned revenue is received, again, cash, received, debit, I can't credit revenue because I haven't earned it, so it goes into the buddy account. And then one more, just real quick. We're going to assume our fiscal year end is December 31, and we're going to situations as best we can with these terms. So with this problem, we're stepping it up another notch because we're using real world transactions. A company's employees work towards the end of December, but they don't get their check in January. So that is going to be the accrued expense. Cash received by a ballpark in January for season tickets. I wish, people, go Rangers. To all home baseball games to be played in the summer, we're getting the stadium, the team, whatever, is getting the cash up front, but they aren't earning it until later. So this is an unearned revenue when they are depositing that cash. A 2-year premium paid on December 30 for an insurance policy, that is going to be a prepaid expense. And finally, interest on an interest-bearing note receivable for the last 15 days of December when that note matures on February the 14th. If it's a note receivable, we're going to be earning interest, and we're going to earn it before the maturity date because the note spans 2 fiscal periods. So that's going to be an accrued revenue. So I think we've kind of looked at the questions that you have. I have a list of, again, these are theory-based questions. We did not even attempt to work actual problems, but I can tell you anytime there's a worksheet problem where you have adjustments, you're doing accruals and deferrals. You maybe just didn't realize that's what they're called. So this is my email address, and I'll leave this up just a bit. My website is also there in case you're interested in the products that I write for contest preparation, and that information is on the product sales tab. Coaches, you're welcome to email me anytime with questions about contest procedures or even for help working a problem, but please train your students that I cannot respond to email from students. I only respond to teachers and coaches. So I want to conclude by saying that teaching accounting has always given me so much joy. I'm no longer in the classroom. However, I hope I have helped you today, and perhaps by helping you, I can still help with your students, the issues that they might have. So because the topic of accruals and deferrals is so critical to a student's understanding of accounting theory, If you still have any fog and you did not feel comfortable posting a question today, please email me. I love clearing the fog, and we can talk theory by email. So I do thank you very much.
Thank you, LaVerne. No new questions in the box yet, so we appreciate everyone joining us today. I really appreciate your time, LaVerne, and all that you do to make your contest one of the best we have. You're very always conscientious about it. I know how hard you work, and it always shows. So we appreciate it. You bet. And thanks for joining us today. And we can stop the recording.